Hello, everyone. I'm your host, Étienne Joncas-Bouchard, and I'm very excited to be back for another great episode talking to you about the Canadian ETF industry, answering your questions, as well as hosting a great guest from here at Fidelity. Before we get into that, just a quick recap of our last episode, which we launched in early July. We had the chance to answer questions about ETFs, Fidelity ETFs, including our all-in-ones. We talked about some of the notable trends in the Canadian ETF industry. We also had the chance to ask our guest a bunch of questions about his role at Fidelity, some of the main key trends that he's identified, as well as what his favorite restaurants were in Montreal. So we also like to make it a little bit lighter sometimes. And today, I guess, one of the main things that I want to highlight is we're joined with another great guest from Fidelity, Andrei Bruno, who's our director of ETFs. Andrei, thanks for joining us. So I think it's going to be a great episode. And obviously, a lot of things have happened over the past month. Just from a market perspective, before we get into kind of the industry, obviously there's a continuation of a positive trend in equity markets. We've seen bond markets actually sell off a little bit as yields have risen with inflation expectations coming back a little bit. So we'll take a deep dive into that with our guests a little bit later. Before we do that, let's highlight some of those main points that we've seen so far, I guess, especially for the month of June, which we recapped the month of May last time. Let's do the month of June this time. $7 billion in total inflows into the Canadian ETF industry. That's bringing the total for the year at around $54 billion, which is well ahead of record pace, if you will, that was set last year. So I think that's overall a very, very positive development. There's continued appetite for ETFs by Canadian investors. Obviously, one of the main things I want to highlight, and I guess thank everybody that's listening into this call, is thanks for supporting Fidelity. It was one of our record months in June. We brought in a total of about $1 billion in net new assets. That's bringing the year-to-date total to slightly above $5 billion. So really a big thank you to everybody that supported us. And obviously, the main headline there has been our all-in-one ETF portfolios, which I'm sure we're going to get a chance to talk about again today. Some of the key highlights that we've noted, something that we actually chatted about last time was the real growth in demand for international equity ETF. That's really continued into the month of June. We saw, more than 50% of equity purchases or purchases into equity ETFs going to international markets. And that includes emerging markets, Europe, and other areas that are basically outside North America. We also saw fixed income flows actually slow down a little bit. But we saw that money mostly came out of kind of the short-term cash alternatives. A lot of investors using that as kind of a cash wedge in their portfolio, a way to stabilize volatility, but then also use that to fund purchases once they're ready to go back into more risk-on markets like equities, for example. Other key notes I put down here, sector ETFs, surprisingly, sector ETFs have been a really, really popular area for Canadian investors for a long time, notably on, for example, buying bank ETFs, buying financials ETFs, energy ETFs. And those have been a bit less popular over the last couple of months. We're talking about $850 million of outflows in June alone. And there's maybe many reasons for that. One of those reasons could potentially be just taking a bit more of a broader approach, because we did see demand for kind of those broader market like index products, as well as kind of those more core solutions. So on our side here at Fidelity, we're talking kind of those more aggregate US equity exposures instead of sector specific. One other point could be that they're both in the cyclical part of the market, and you saw post kind of that initial tariff tantrum, let's call it, we did see a rally on kind of the more momentum names, which falls in the growth category like tech, like comm services, consumer discretionary, notably in the US. So those are some of the main highlights that I had. I guess the last point I'll make, I said we did bring in a total $1 billion here at Fidelity, but we also had one of our flagship products hit $1 billion in assets under management, and that's our Global Innovators ETF, ticker's FINN. So really wanted to highlight that. It's been, a great product, and obviously managed by an amazing manager named Mark Schmel, which many of you might know already. Andrei, I'll kick it over to you. I mean, we'll keep all the interesting questions, but I want to get your thoughts on kind of all the trends that I highlighted there. Is anything that stuck out to you? It could be something that I mentioned, but something else maybe that I missed.
Yeah, I think the discussion around the sectors. I think what's interesting there is we're kind of shifting back into a kind of a risk-on environment, and you highlighted money markets. So if you looked at kind of the first half of the year, early on in the year, particularly, you saw a lot of money flowing into money markets. Obviously, there's a lot of uncertainty surrounding tariffs. People weren't sure what direction things were going, and you also saw a shift in international. If we look at kind of this month's data, which I'm probably stealing for what you want to talk about next month, but we are starting to see a little bit of a shift back into the US markets. And I think it's after some time of, the dust settling from the initial shock of the tariffs. But to digress back to the sectors, I think we're maybe, investors aren't exactly sure, what particular sectors
Exactly
where to put their money. They want to get risk back on, but they don't want to make any bets on the sector. There still is quite a bit of uncertainty surrounding the tariffs and how that's ultimately going to funnel down. Obviously, inflation, there's some expectation that's going to heat up, but for the most part, it's been contained so far. And, surrounding the tariffs as well, there's still, they just inked, the U.S. just inked a trade deal with Japan. So I think there's going to be a lot of interesting things continuing with this tariff story and how it's actually going to play out over the next 6 months. Are there going to be new deals? Ultimately, are we going to get back to kind of business as usual as these trade deals funnel in? So it'll be really interesting to see. But yeah, again, a lot of money's coming out of those money markets, out of the short term, and going back into equity markets. So it seems like folks are the appetite for risk is a little bit back on.
Putting money to work, and like your point is to like, we'll see where we are in 6 months. I mean, like, we'll see where we are when this episode airs. Like, things move pretty quick, and it's been a really interesting year, obviously. And before we get to answering the internet, another thing that I guess I'll mention is, we had our quarterly call with our great colleague, Bobby Barnes, that we work with in the US not so long ago. And he basically, like, we've already had like 3 different markets so far this year, right? So for investors, it's like, if you make that tactical call to go in a specific sector, you go in a specific style, right? With a factor or with whatever, like you might be right for a couple weeks, a month, a quarter. You might be right for longer if momentum persists, but like, it's been a very choppy market, right? So whether being, and that could be said for going risk on or risk off, but even just from more specific, like a sector style part of the market. So you want to be invested, but maybe not making that big call.
I think there's no trend. There's been no real trend, whether you're looking at a sector.
Trend is no trend.
Or a factor.
Cliche.
It's really easy to get whipsawed in a market such as this. Everyone's broadly on risk. I think that's why you're seeing quite a bit of flows go into broad equity markets, whether it's international or US broad-based larger cap markets. Is markets doing okay, risk is back on. We just don't know exactly where to put it.
One last thing, crypto's done exceptionally well from a performance standpoint, and flows have been fairly muted so far year to date. Like, I would have expected it to be a bit more in demand. Thoughts?
Yeah. I would say,
just,
I'll speak, specifically to our lineup as well, because I'm pretty in tune with those particular flows. Like, it's been fairly steady, but I would say there's been no real uptick per se.
Yes.
Still steady kind of inflows, but in a market such as this, to your point, you'd expect kind of more money flowing into the space. We haven't necessarily seen that, to ETFs particularly. Now, we can obviously take a step back and talk about the broader crypto market and people investing directly. I don't have those exact numbers.
I don't think anybody does.
Obviously, more money's flowing in if the price is going up, more buyers than sellers, as they say. But I'd say, in ETFs, it's been pretty, steady as she goes, I would say, in terms of inflows.
Cool. All right. Well, let's get into it, man. Let's answer the questions from the internet. This is a segment that I particularly love. It gets a chance to get in tune with our audience. We try to every month we try to go and kind of scour the internet, go through Reddit, go through, you can submit your own questions to us directly. We'll take them anywhere. And the objective is to answer them to the best of our abilities, to provide insights that, can make you a better investor, make you a bit more knowledgeable about the ETF space. So, what I'll do is we'll go back and forth kind of answering the various questions. I put down 6 here, and, we might not go through all of them, but we'll do our best. We try to keep these to 30 minutes. And Andrei, I know you and I can go and ramble on for much more than 30 minutes. So first question we have is, I'll ask you right ahead, and then maybe I'll add, my 2 cents after, but if you could choose only 2 ETFs, what would they be and why?
2 ETFs to purchase in this market right now?
Yeah, it's just like, or if you're starting as an investor and you're thinking, what 2 ETFs should I start with? Let's do it. Let's tilt it that way.
Yeah. I think if you're looking to get into investing, and I think the first idea that comes to my mind is you want to build kind of a core portfolio. So to get your feet wet. So when I think core portfolio holdings, And obviously it depends on, your investment horizon.
Yes. There's asterisks everywhere here.
Let's assume you're, a younger investor looking to get into markets. Like where my head initially goes is you want something with broad equity market exposure. You don't want to make any, tactical bets right off the hop. You kind of want to dip your feet in. So there's, obviously if you take a look at historical returns, and, as we all know, historical returns are not necessarily indicative of future results. But U.S. equity markets have done exceptionally well and have outpaced Europe and other jurisdictions. So for me, one of the first stops I would do is look at core broad equity market exposures, particularly to the U.S.
Yep.
So that's the first place I like. Do you want to look for specific examples? Or?
No need for tickers, no need for names.
Yeah, so
kind of just more like investment thesis idea that can be done through ETFs, obviously, and that's a great example, right? There's a number of core U.S. equity,
and that's
ETFs.
The first thing I would look at, and the second thing I would look at, particularly if you have a long investment horizon, a little bit more risk tolerance as well, is looking for growth equities. Like if we're looking to compound over time. I like the idea, and that could be global or U.S. If you want to diversify a little bit, maybe look at global growth, which will have some U.S., some Canada, some international in there. Yeah. That is the second piece I would look for. Again, if someone who's looking to start out longer time horizon investment, higher risk on, those are the two building blocks I would use to shape my initial portfolio.
Cool. Yeah, it's a great answer, and like you said, it's dependent on whoever the investor is. Various investor profiles, and that sometimes is with where you are in your career or age group, if you will, just demographic, I should say, maybe is a better way to put it. Sometimes it's just risk tolerance. Like doesn't necessarily mean what age you are or how much assets you have. It's just some people are more risk averse than others. But I'm with you. I'm kind of the same as usually you want at least some core equity allocation. I'd kind of cheat on this one. Also say that I think the multi-asset category is really interesting, right? So you can buy. There's a number of ETF portfolios. Obviously, we have some here at Fidelity, like our all-in-one ETFs. That's a great example. But something it's basically going to rebalance for you. It's got this mechanism to rebalance from a geographic standpoint, from a style standpoint. Like you're basically that's getting as core as you can. But maybe that's an easy way out.
No, I think it's a good point though, right? Because you get that core portfolio that's going to rebalance for you. It's going to do what it has to. It's diversified. And then, if you want to get into some more satellite positions around the edges, it kind of mitigates the risk of you kind of stepping in any pointy objects.
So then if you're talking two, you get that portfolio and then add something that that's of interest to you or something that something that's, it's kind of the old core and explorer or, satellite positions like you mentioned. But that's a good way to think about it, I think. Okay. Second question. Are precious metals or Bitcoin ETFs worth adding to said core portfolio?
So generally, again, I'm biased, but I do like a little bit of Bitcoin in there. Obviously, from a risk return perspective, when we thought about the allocation to our all-in-one portfolios, the main lens that we were looking at, what percentage should we add to the portfolio was risk.
Yeah. Drawdown risk more specifically.
Because if you do, right? You go to your finance textbook and you efficient frontier and risk adjusted return it, it would tell you to do 100% Bitcoin, which is obviously not a reasonable.
Yeah. So let's say most investors probably don't need
exactly. That. So what we were looking at is how can we maintain, if we're thinking about a 60-40 portfolio, how can we maintain kind of the similar risk return characteristics or risk characteristics of a 60-40, and at what percentage can we add Bitcoin in there to maintain that similar risk profile while getting a little bit of ideally pickup from the Bitcoin returns in there. So that's how we ended up on that range. So we think that range is kind of a reasonable range to have in your portfolio. Yeah. Again, every investor is going to be different, but that's how we thought about it.
Sure.
Precious metals is there's a place for that as well.
But it's kind of sorry not to cut you off, but just I think for both of those, the concept or the idea is to say this is another layer of diversification, something that's got a bit of a less correlated return profile or return stream. For example, and a lot of people have tried to compare gold and Bitcoin together, and I think it's kind of been debunked that they're not really equivalent types of assets, but both of them kind of achieve the same objective, which is not necessarily correlated to traditional asset classes like fixed income equities, or at least they might in certain phases, like say a 2022 when there's kind of nowhere to hide. But for the most part, they do offer that added diversification to your traditional. And you mentioned 60-40. Just for our audience, maybe that's less familiar with that term, that's a kind of a balanced portfolio of 60% equities, 40% fixed income securities. And then adding kind of both of these asset classes can be beneficial, to your point, on a risk-adjusted basis, right? So
yeah, when you think about gold too, there's a couple different ways you can get the exposure. Like you can get it through, pure play like gold futures or spot gold ETFs, but also gold producers.
yeah, gold miners.
If you look at gold producer stock prices, they're very correlated with the price of the metal. Ultimately, when you talk to the CEOs of these producing companies, like their expectation is you're buying our company because you want exposure to gold. Like if you take a look at these producers, they don't hedge their exposure to gold. Like you would think when you think about gold futures, it's you're like, oh, like
levered gold play.
These producers probably hedge their exposure when gold's high. They'll sell futures to lock in their price. They actually don't do that because their investors' expectation is if I'm buying, a gold company,
I want to be sensitive.
I want to be sensitive to gold. Fair. So that is also another way that you can work kind of gold in an indirect way into your portfolio.
That's a good point. I like that. Okay. I'll answer this next one. They'll start and you can jump in. Is there a downside to the explosive growth of Canadian ETFs? I'll get ahead of it. Let me take this one. I need to do some talking. God, I can't get you to work the whole thing. Is there a downside to explosive growth Canadian ETFs? And I don't see many. There are some downsides though. And I think the main one for me is it just creates more opaqueness and more confusion with regards to just the sheer amount of choice out there. And, even some of my friends that are like, they do some of their own, a lot of them work with advisors. A lot of them do it on their own. Some of them do both. And then they often ask me is like, which ETF should I buy? And that's like such a generic question. It's like almost impossible to answer now because obviously there's so many other questions that need to follow that one from my perspective. But there is just so many options out there. And even if you look at let's just take one specific type of ETF, dividend ETFs, there's 15, 20 different dividend strategies that are available in the Canadian marketplace that have the name dividend in it, but then give you very different exposures, very different styles, very different sector exposures, different underlying holdings, because maybe they're looking at dividend growth, maybe dividend yield, maybe payout ratio, maybe other metrics, like the quality dividend mandates. Those exist as well, that are maybe more growth tilted. So I think the growth of the Canadian ETF industry, or the explosive growth, that was the question here, I think that's the main risk for me. Other than that, I don't really see it because it's a disadvantage and an advantage because it gives you more options, but it just creates, I think, a lot more opaqueness.
Yeah, to expand on that, it is a bit of a double-edged sword, right?
It's a double-edged sword. Absolutely.
I mean, the nice part of it is particularly if we're thinking about your do-it-yourself investors with, you've got a discount brokerage account, you like to trade for yourself. If there's a theme you want to invest in, if you went back 20, 30 years and you want to invest perfectly, you might have to go out and buy the stocks yourself. Now we've essentially got an ETF for everything. So, it is bringing, whether it's thematic themes that investors want to express views or investing on a particular area of the market, it is nice that we do have an ETF for that. But to your point as well, it can be overwhelming to try to figure out, if I do want to buy this, now there's 40 of them, which one do I buy?
And I think with that growth also comes you have to innovate on a product standpoint, which is obviously your part of your role, and maybe we'll dive into it a little bit shortly. But when you have to product innovate because there's so many different products, it also means if you're innovating, there's generally a higher complexity level, right? So there's maybe derivatives being involved. There's maybe leverage being involved. These are things that maybe for most investors is something that's maybe a little bit more complex than just a long only. I'm buying, the S&P 500, or I'm buying just a U.S. equity ETF, right? Or so with the growth comes complexity. Anyways.
Yeah, I mean, I'd say from a product,
which is fun for you.
What is it is fun in a sense when the market is presenting a financial problem that we're trying to find a solution for.
Yeah.
And there's just so much that we can do under the hood, whether it's employing derivatives
or even liquid alternative ETFs. It's a whole other.
We can tweak risk return profiles to meet a specific investor demand. So if we think back when mutual funds and ETFs were only long only strategies, we didn't have those tools at our disposal. But now it's fun when you're doing product development. Is if there is a specific problem or risk return profile that investors are seeking, is like we can package stuff together and put it in an ETF and solve that problem for Canadian investors.
All right. I had a few other questions, but you know what? Like I think we've taken a ton of time answering questions already, and I want to ask you some questions. So let's get to it. Let's get to our little interview part of the podcast. And I briefly introduced you earlier, saying you're our director of ETFs, but like it can't be, it's very easy to gloss over that to say director of ETFs. There's a lot of things that you do behind the scenes, a lot of work that you and your team do to make sure that we have best in class products and all that. I want you to take the time a little bit to explain to the folks kind of some of the ins and outs of your role, what your team does, and how also just kind of like why it's important for a lot of our investors and our products, all the behind the scenes stuff that I mentioned.
Yeah, so I'd say kind of in my role, there's kind of two silos that I operate within. So we've got the product development side. And so on the product development side, we're doing everything from, we essentially take, we go from idea generation all the way up to product launch and maintaining the product post-launch. And, what goes into product launches, and I've said this many times before, it requires a village to launch a product. So it's not just my team. We interface with our folks in legal, our sales folks, our operations folks, kind of everyone in the firm gets involved with a product launch. But, what we do is obviously we're looking, what can we bring to the market? And so there's, a couple ways we go about that, whether it's we're filling a gap in our lineup where, we're not well represented. It could also be kind of client-driven demand for, the market is looking for a particular product, and that's something we want to bring to satisfy a need of the Canadian investor and our clients. So what goes into that? We do a lot of market research. What is out in the market? Taking a look at trends, market trends, and that all kind of funnels in. We solicit a lot of feedback from sales as well, what they're hearing from clients. We kind of distill that down to kind of figure out, how can we structure a best-in-class product. And, we've got a lot of levers that we can pull on in terms of, asset management. We obviously have a team in Canada that does asset management, portfolio managers here. We've got portfolio managers in the US. We've got portfolio managers in Europe as well. So we've got a lot of levers and a lot of capabilities within the Fidelity complex that we can tap in order to get this best-in-class product to market. And it often takes, quite a long time. Sometimes if we have a new innovative solution, we'll throw that in and we'll incubate it and
test it, play around with it.
Test it out, play around with it. The one thing that we do ad nauseum is, stress test our products, manage the risk, whether it's market risk. We're taking a look at what can all the risks be? How can this potentially break? How can we protect investors to make sure that this doesn't break, whether that's from a product design perspective or just under the hood from an operational perspective. So a lot of work goes that. And the second, I know this is a long-winded answer here, but
it's okay. It's good.
The second kind of silo I operate is kind of on the ETF capital markets and management side. So in that role, we're essentially dealing with all the idiosyncrasies surrounding how ETFs trade.
Yep.
So now, as we know, mutual funds, you get your 4 p.m. NAV, ETFs trade within the day, intraday, like a stock. So we're kind of making sure that process is running smoothly. So we're interfacing with the market makers on a daily basis, making sure that our ETFs are trading with reasonable spreads. There's adequate liquidity so that our clients can have a very smooth experience when trading in and out of our ETFs. There's the basket making process. We have to provide holdings to the market makers so they know how to actually price it within the day. So we make sure that process is running smoothly. All our market makers have everything they need from us to make sure that they can make adequate markets in our ETFs on a day-to-day basis. So a little more, we interface anything with the exchanges when we're listing, so it's dealing everything market related with the ETF. So those are kind of the two broad sides, the product development side and the ETF capital markets side.
Sounds like a busy job.
Keeps me busy.
Well, that's awesome. I guess, not to like run through your resume, but like how did it come about to like, fall into this chair, which now like like you said, you're heading up this product development team on the ETF side, which like we're up to more than 50 ETFs. Like there's a bunch more in the pipeline. Like I said, you're busy, but like how does one come, like, I don't know, not to say that, maybe somebody in our audience is like aspiring to be a product development director at an asset manager, but kind of maybe if you just want to give us a few insights into your background, how you got into this role.
Yeah, so my background, I'd say I probably took a very atypical path to get to where I am. My background is more on the sales and trading capital market side.
Okay.
So early on in the career, I started FX trading on the buy side, some fixed income trading in there as well. And then from there, I went to the sell side and worked in derivative sales. So, FX derivatives, interest rate derivatives, and some money market sales in there as well. So all that to say, I was mostly an OTC guy, over the counter. All those products are over the counter. And then I got into Fidelity, having some fixed income background. I actually started as a strategist. And so I worked a couple of years there. And then eventually, I think our ETF lineup had just grown substantially, where there was more of a need on the ETF capital market side. Before, we only had a handful of ETFs. It was kind of, someone could do it on the side of their desk.
Oh, yeah. Well, we all kind of did it.
Exactly.
Everybody was chipping in.
It was spread out everywhere.
Not ideal.
Kind of became a full-time job.
Yeah.
So then that's how I kind of got brought up. And at that time, I was only the director of the ETF capital market side. And then eventually, the person responsible for product development moved on to another role, got a promotion. So that's when it got recombined.
Not a big deal.
That's when it got recombined, and I got the product development as well as the ETF capital markets. There's obviously a bunch of school interlaced in there, CFA, MBA, all that fun stuff.
Yeah. No, that's awesome. No, it's like you said. I mean, as our assets grow, as the lineup grows, we definitely had a need for that. That's awesome, and it's great to work with you every day. So I guess I'll say that.
Appreciate it.
It's nice.
Likewise.
Thanks for coming on the pod. No, okay. Let's move to the next question. One that I get quite often is because this is something when a lot of investors think about ETFs, they think about passive investing. And obviously here at Fidelity, and for you folks listening in, we're going to talk about this multiple times because it's something we hear about all the time. A lot of people associate ETFs with passive investing and, kind of the concept of you can't beat the market. And that's really not what we're about here. Without going into a debate on which is better, and I think it's less and less of a debate. It's just kind of a difference in preference and a style. How would you go about how would you use passively managed ETFs and smart beta or factor based and active, the kind of three main different styles? And you could bucket, let's say, factor and active together, but how would you pair those together when you're building out a portfolio as an investor or an advisor?
Yeah, I think what it's actually interesting now that we have kind of all these three buckets at our disposal. If we think about those passive beta only products, I think they certainly do have a place in a portfolio. If you really want to take a rudimentary approach to it, you can think of the one third passive, 1/3 smart beta, 1/3 active. So you want to get your just pure play beta exposure. With your smart beta, you can put some tilts around the portfolio. So maybe, depending on where you are in the business cycle, maybe, you're within a recession or something, you want to look at some low vol stuff and you want to put some factor tilts in your portfolio. You can express that through the smart beta. There's also fixed income, smart beta as well, where there's some systematic strategies that you can also lump in there as well. And then on the passive side, obviously we're Fidelity, we believe in active management.
Yep.
We believe in the ability to outpace our benchmarks, and that's where you can get a little bit more juice in your portfolio. You get someone actually taking a look at the basket of stocks, and trying to find those winners and avoid those losers. And obviously at Fidelity, we're big believers in that. We've got a very robust, portfolio management team, like I said, spanning multiple continents. We've got folks everywhere, analysts everywhere. We've got a lot of bodies and a lot of eyes looking at the markets globally and trying to find those gems and find those winners. We've got a handful of mandates, quite a few mandates where we've been able to do that, and we strongly believe in that. So I do strongly believe in active management.
And it's a growth phase. It's a growth part of the Canadian ETF industry in the sense there have been more active ETF listings in the past year than there has been, passive ETF listings, right? So I think you're seeing innovation there, and that's actually a good segue into my next question, which is, what's one innovation in the Canadian ETF industry that either we've seen recently or that you're expecting soon that really has caught your eye that's interesting for most Canadian advisors and investors?
Yeah, I think what's been interesting, obviously, the use of derivatives within ETFs has been starting to get a little bit more popular. I think that's where you also see a divergence between mutual funds and ETFs. There are some covered call mutual funds as well, but if you take a look at kind of the option based strategies, it's almost like the lion's share of the products are sitting within the ETFs, and kind of as an extension of that or tangentially related to that is liquid alternatives as well.
Yeah,
we're starting to see a lot more liquid alternatives, both on the mutual fund side and on the ETF side. But historically, if you went back several years, those liquid alternatives were kind of confined to the mutual fund space, and now we're seeing a lot more come to the ETF space. So I think we're going to continue to see quite a bit of growth in the liquid alt arena. And it's something
and that's something I imagine like market makers becoming more comfortable also with, pricing these different types, like more sophisticated strategies. I don't know if that's has to do with it, or is it just because
yeah, for sure,
the vehicle has been more popular.
And I mean, I think the important part there with the alternatives is the liquid part. And that's, when we're doing product development, we have to be very conscious of that, because ultimately, you can put a liquid assets in an ETF, but you're going to be able to drive a bus through the bid offer spread, and that's not a great client experience. So, when we're developing products, particularly in the ETF space, we're very cognizant of the liquidity profile of the underlying, because ultimately we want to make sure that our ETFs trade as close to NAV as possible.
Cool. A couple more laid back questions to just wind down here. First of all, I'm putting you on the spot. We're going to a Jays game after this. Favorite Blue Jay?
I'm gonna go with Vladdy, and
Dingers.
I think it's Vladdy bobblehead night tonight as well.
Is it?
So I think
gotta get in early.
Hoping we'll get a little bit of that merch to take home.
Love that. Okay. So last question. You just got back from Cabot, Cape Breton. You're an avid golfer, as I am. How was that? And any other cool trips planned? Shooting?
It was great, and don't confuse avid golfer with good golfer, but.
You appreciate golfing. I never said you were good at
it. No, it's fantastic. It's great. For the folks who haven't got out east before, it's fantastic. We were out on the water. Cabot is in Inverness, Nova Scotia, out on the Cape there. So beautiful vistas, but the golf courses as well were quite breathtaking. I will say, I haven't played a ton of link style golf before. The greens will get you. Rock hard firm. You cannot hold a green. A lot of balls rolling off. Crispy fairways. Balls just roll for miles and miles. But no, it was a great experience. Great service. Great location. If you're into golf, I would highly recommend. We are not getting kickbacks from Cabot. I wish we were, but it was a truly wonderful experience.
Awesome. Yeah, and the folks in Atlantic Canada are the best. So I'm sure that was a great trip.
Oh, yeah. The folks there, I often say this. I don't want to throw shade on the rest of the country, but folks in Atlantic Canada are probably the nicest folks in the nation.
There you go. All right. Well, thank you so much for doing this, Andrei. It's been great. I'm sure we'll have you back on in the future. I'll see you in a couple minutes when we head to the Jays game, but we'll catch you next time in about a month or so. And thank you for listening in as always. See you next time.